Every company you use every day, your phone, your Uber, your Airbnb, possibly the laptop you are watching this on, started as a small team with an idea and no money. So how do they go from an idea to a billion-dollar company? The answer, in almost every case, is venture capital. In this video, we are going to break down exactly how 95 funding rounds work, from the first small seed check all the way to an IPO. Venture capital, or VC, is private funding given to early-stage companies with high growth potential. Venture capitalists are investors who pool money, often from institutional investors like pension funds and university endowments, and deploy it into startups in exchange for equity, meaning ownership shares in the company. The bet they are making is simple. They invest in many companies knowing most will fail, betting that one or two will return 10 times, 50 times, or even 100 times their original investment. Famous venture-backed companies include Apple, Google, Facebook, Uber, and Airbnb. All of them received early venture capital funding before they were household names. The seed stage is the very beginning of a startup's life. At this point, the company often has an idea, maybe a prototype, and little to no revenue. The founders are trying to prove that the concept works and that people actually want it. A typical seed round raises between $500,000 and $3 million. The investors in this stage tend to be angel investors, high net worth individuals, early stage seed funds, and sometimes people in the founder's own network. In exchange, founders typically give up between 10 and 25% equity. The money pays for building a minimum viable product, hiring an initial small team, and running early market tests. The risk at this stage is extremely high. Many seed-funded companies never reach Series A. The majority of the bet is on the founders themselves, their ability to execute, adapt, and push through. If a startup survives the seed stage and shows real traction, it can raise a series around. Series A is not about proving the idea works anymore. That should already be established. Series A is about proving the business can scale. A typical series raises between $2 million and $15 million. The investors at this stage are established venture capital firms, names like Sequoia, Andreessen Horowitz, and Benchmark. Founders typically give up an additional 15 to 30% equity. What does the money go toward? Building out a sales team, investing in marketing, expanding the product, and hiring across the organization. What VCs want to see before writing a series a check is product market fit, clear evidence that a defined customer base actively needs and uses the product, a growing user base, and signs of repeatable revenue. Series A is where most startups fail. Transitioning from a working product to a scalable business is one of the hardest challenges in entrepreneurship. Once a company has proven it can scale, it enters the later funding stages: Series B, Series C, and beyond. Series B typically raises between $10 million and $50 million. The company already has a proven revenue model, and the goal now is to scale it aggressively, expanding to new markets, hiring rapidly across all functions, and building out the infrastructure to support growth. Series C is pre-IPO territory. Rounds at this stage can range from $50 million to $500 million or more. The investors are now not just traditional VC firms, but also hedge funds and private equity players. The company is often operating globally, and the conversation has shifted from whether this business works to how large it can ultimately become. Valuations at this stage can run into the hundreds of millions or even billions of dollars before a company ever trades on a public stock exchange. Let us visualize the whole journey as a funding ladder. At the bottom is the seed round, $500,000 to $3 million. The company is proving the idea. Next is Series A, $2 to $15 million, proving it can scale. Then Series B, $10 to $50 million, scaling fast. Then Series C, $50 million to $500 million or more, going global. And at the top, the IPO or acquisition. This is when the company either goes public on a stock exchange, often generating billions in new capital and allowing early investors to exit, or is acquired by a larger company. Each step up the ladder dilutes the founder's ownership, but increases the total value of the company. A smaller percentage of something very large is still worth far more than 100% of something small. Not every startup gets VC funding. Investors are looking for a very specific combination of factors. First, a large market. Is the total addressable market over $1 billion? VCs need room for 10 times growth. A great product in a small market rarely justifies venture scale capital. Second, a strong team. The founding team matters more than the idea itself. Most VCs will tell you they invest in people first. Execution is everything in the early stages. Third, an unfair advantage, a patent, a proprietary technology, a network effect, or a distribution channel that competitors cannot easily replicate. Fourth, traction. Early users, growing revenue, or strong engagement signals that the idea is working in the real world, not just on a slide deck. And fifth, scalability. Can the business grow to 10 times its current size without 10 times the cost? Software scales. Marketplaces scale. Pure labor-intensive businesses are harder to make venture scale. One of the most important concepts in startup funding is equity dilution. Every time a startup raises a new round, it issues new shares to investors, which means existing shareholders, including the founders, own a smaller percentage of the overall company. Here is what that looks like in practice. Founders start with 100%. After the seed round, where they give up 20%. After Series A, they give up an additional 25%. Now they own 60%. After Series B at 20% equity given up, they are at 48%. After Series C at 15%, they are down to approximately 41%. But here is the critical insight. If the company has grown in value at each stage, and venture-backed companies typically raise at higher valuations each round, then 41% of a billion-dollar company is worth $410 million, which is worth infinitely more than 100% of a company that never scaled. Dilution is not the enemy. Lack of growth is. So what is the key insight from all of this? Venture capital is not free money. It is a high-stakes partnership between investors and founders. Investors risk capital. Founders risk control. The best VC-backed companies use that capital to grow faster than they ever could alone. And the math works out spectacularly when it does. When it does not, everyone loses. Understanding how this system works makes you a more informed investor, a more sophisticated consumer, and if you ever start a company yourself, a far better positioned founder. If this video helped you, please leave a like and subscribe. It helps us reach more people with financial education. New videos every Monday, Wednesday, and Friday.